Let's go back to chapter 8 and exercise. Right. Okay. So for exercise, let's do exercise 2. It says on November 1st of 2021, a company borrows $60,000 from a bank, and the company signs a 3-month, 7% note payable. Interest is payable at maturity. Aviation's year end is December 31st. So this is November, December, 2 months. Okay, so let's see how we do the journal entries for this. So when we borrow in November, we record the cash has been increased, which is debit cash. And we record the short-term liability, which is note payable for 3 months, $60,000. That's a credit. However, by end of year, 2 months already passed. So 7% interest rate times principal of $60,000 times 2 months out of 12 months. That will give you the fraction. And that will be interest expense of $700 debit to recognize it. And interest, because we are not going to pay right now, so that will be interest payable credit $700. But remember, this is 3 months note. So at the end of January, it's the maturity. So we need to not only pay the principal, but also pay the interest. The note payable should be debited to close the principal of this note. We have already $700 note payable in here to that we recognized already. We need to close that liability. However, for month of January, there is an interest that you need to recognize it. That's just 1 month. So $60,000 principal times 0.007 times 1 divided by 12, 1 out of 12, 1 month out of 12 months. And that gives you $350. So you recognize the expense. This interest expense is the expense for the new year. Okay, the $700 was in the previous year. Bottom line, we need to write a check and send it to the lender, $61,050. Okay, let's do number 4. In number 4, these are also part of your homework, so it's going to help you. On August 1st of 2021, company borrows $21 million cash to expand operation. The loan is made by First Bank under short-term line of credit arrangement. Trico signs 6 months, 9% promissory note. Interest is payable at maturity. First Bank Corp's year end is December 31st. So August, September, October, November, December. That's 5 months in year 2021. Okay. That means we need to record the liability first, which is notes receivable by the bank and providing cash $21 million to the borrower. So the bank will record a note receivable and will release $21 million to the borrower, debit note receivable credit cash. Cash goes out of pocket, right? But by end of the year, the company earned interest income, right? And that's 21 million times 9% times 5 months out of 12 months. And that will be 787,500. Interest receivable will be debited to recognize the asset that we have at this point, and the income will be recognized as interest revenue credit. And that's a 6 months note. That means at the end of January, it's the maturity. So the company will receive a check from the borrower. The check is covering the $21 million principal that needs to be closed, so note receivable will be debited. The interest receivable needs to be also closed. So that's the 787,500 that we already recognized. However, for month of January in new year of 2022, they have to recognize another 1 month of interest revenue for $157,500. And if you add them up, that is the check that they're going to receive, $21 million plus interest of $945,000 total. Cool. Let's do number 5. Number 5 says the company provides cost-effective solution for managing regulatory requirements and environmental needs specific to the airline industry. Assume that on July 1st, the company issues a 1-year note for the amount of $6 million. $6 million note, 1-year note, okay? 6 million, 1 year. Interest is payable at maturity, and that's on July 1st. Okay. Determine the amount of interest expense that should be recorded in year end, adjusting entry under each of the following independent assumptions. Let's say the interest rate is 11%, fiscal year is December 31st. Okay, 11% interest rate, fiscal year is December 31st. What is the year-end adjusting entry? Okay, that's July. And it's July 1st, so July is included. July, August, September, October, November, December. That's 6 months. So 6 months, 11% interest that needs to be recognized. So here is 6 months out of 12 months, 11% interest, and that's $6 million. That's $330,000 interest to be recognized. And journal entry is, okay, it's not showing, but journal entry is interest expense debit. And interest for the borrower, interest expense debit, interest payable credit. For the lender, it is debit interest receivable and credit interest income. Okay, so if it's 9% and fiscal year is September, then July, August, September, that's just 3 months. Okay, so 3 months, that's the calculation. If the interest is 10% and end of the year is October 31st, so it's July, August, September, October, that's 4 months. So that's 4 months. Okay. And the last one, the end of the year is end of January next year. So at the end of January of next year, it will be just 7 months starting July. So that's the interest expense or interest income that needs to be recognized. Interest expense for the borrower, interest income for the lender. Okay. Let me do one more, okay? You have few problems. I'm trying to help you a little bit. So number 7. Okay, here is 7. Says Aspen Ski Resort has 100 employees, each working 40 hours per week and earning $20 an hour. Although the company does not pay any health and retirement benefit, one of the perks of working at Aspen is the employees are allowed free skiing on their days off. Okay, that has nothing to journalize. That's good to have, but there is no journal entry on that. And the reason there is no journal entry because the company does not have any specific expenses that he needs to recognize because of that. Ski resort is open anyway, so if one of their employees wants to ski, that's fine. There's no journal entry, no cost. However, federal income taxes are withheld at 15%. Income tax normally for every person is different because if you are married or single, it might be a little bit less or more. You have more dependent, less dependent. That will be a little bit different. But overall, for now, we are considering everyone is 15%. Okay. And the state income taxes are 5%. Again, that is different for everyone based on married or single and number of dependent. But again, we assume number of 5%. How do you know how much to withhold from your payroll? That's because when you hire someone, you ask them to fill up a form W9, form W4. Form W4 is the form that you ask the new employees to fill out. And based on that, they say if they are single or married and how many dependents they have. And based on that, you can enter those information in the payroll software and figure out individually how much to withhold from each person. But at this point, we go with 15% and 5%. Okay, so FICA taxes are 7.65% of the first $128,400. This $128,400 limit threshold is different every year. So you don't need to memorize this. If you just Google it, FICA taxes threshold, every year you will see it's different. So if I, let's say, go and say FICA tax rate, let's say 2023. Okay, so for 2023, it is $160,200 until an employee wages reaches $160,200. Social Security must be withheld at 6.2%. And okay, who's gonna pay the other 6.2%? Because Social Security is 12.4 divided by 2 is 6.2. So employee pays 6.2%, employer pays the other 6.2%. And that's up to first 160,200, right? In year 2023. If employee makes more than that, it's not subject to FICA, Social Security taxes. Okay, FICA is two things: Social Security and Medicare. Social Security is 12.4%. up to first $160,200 of income for year 2023. Medicare is 2.9% divided by 2. Half of it paid by employee, half of it paid by employer. So 2.9 divided by 2 is 1.45%. 1.45% of every single income, no matter what. So there is no threshold. For Social Security, there is a threshold, right? As you see here. But for Medicare, there is no threshold. For every single dollar of income you have to pay overall 2.9% of Medicare, half of it by employer, half of it by employee. So 2.9 divided by 2 is 1.45. However, just extra information, employees that earn more than $200,000, single employees, pay additional Medicare tax of 0.9% of income. And that's only paid by employee. Employer is not responsible whatsoever for that. So let's say it's a single person at this moment as we speak, income over 200,000 by employee needs to be paid additional Medicare tax of 0.9%. If it's single married, I mean, it's, I believe, around 250, above 250, then it will apply 0.9% additional Medicare tax. So far, so good. Okay, so where are we? So this is a little bit outdated amount that is in here, but that doesn't matter. So it's a 1.45% for Medicare, right? 1.45% for Medicare. 6.2% when I say 7.65, where is that coming from? 7.65 is 6.2% for Social Security and 1.45% for Medicare. Combined, 6.2 plus 1.45 combined is 7.65. Okay, so it's 7.65 up to the threshold, right? But after the threshold, there is no more Social Security. The only thing remains is Medicare, right? So 7.65 is a combination of 6.2 for Medicare, 1.45, 6.2% for Social Security, and 1.45 Medicare. Social Security will stop as soon as you get the threshold, but Medicare will continue, as you see, 1.45% for every single unlimited amount of income that you have. Unemployment taxes will be paid by employer only. And unemployment taxes is different. Overall is about 6% or 6.2% sometimes. The standard is 6%, but sometimes the government pushes to 6.2%. And that happens when the government is paying too many unemployment checks, let's say during COVID, and that might be added to 6.2 instead of 6%. The 6.2% that here you see, it's unemployment tax, but this unemployment tax is up to first $7,000 of income for the year. So the only first $7,000 of the income of the year. Anything after that, there is no more unemployment tax, okay? First $7,000. Now, you might say where this unemployment tax is going, the 6.2% goes in two places. One goes to the state unemployment agency, if one exists in that state. Let's say in California, we have it, we call it EDD. The 0.6% goes to federal. So 0.6% to federal and The rest goes to EDD. So 0.6% goes to federal, the rest goes to EDD. But when I say the rest goes to EDD, how much is that? Let's talk about the normal unemployment tax, which is 6%, okay? That's the normal. So assuming that's the 6%, 0.6% goes to federal, 5.4% goes to EDD in the state of California, let's say. Out of that 5.4%, don't think every time it's 5.4%. No. When you open a business, you start somewhere in the middle, let's say 3.9%. And if you don't have firing and no one claim unemployment checks for a while, your 3.9% keeps going down and down and down. But if you start firing people and they ask for unemployment check, then your 3.9% goes up and up and up to maximum 5.4%. Okay, so 5.4% is the standard, but doesn't mean every company is paying 5.4%. It starts somewhere in the middle. It can go a little bit lower. It can go a little bit up to maximum 5.4%. The 0.6% goes definitely to IRS no matter what. Okay, so 0.6% goes to IRS no matter what, but 5.4% goes to EDD, but not all of that. 5.4% that goes to EDD in the state of California might be a little bit less, but maximum 5.4, yes. And this additional 0.2 that you see in here, that happens only when it's necessary. Otherwise, standard is just 6%. Okay, let's look at the journal entries for this. And okay, the total salary is 100 employees times 40 hours times $20 each hour. That's $80,000. Agree? Withholding are for federal income tax 15%, state income tax 5%. Those are coming from the information employees and provide in the form W-4 at the beginning when they get hired. FICA tax, as I said, it is always 7.65%, which is Social Security, 6.2% plus 1.45% Medicare. Okay, and that's $6,120. So total withholding is $22,120. Actual direct deposit to employees will be only $57,880. And FICA, which is 7.65%, that is out of the whole thing, $80,000. That's $6,120. But unemployment, as we had the information, is 6.2% of the first $7,000. Assuming this is at the beginning of the January and no one passed that $7,000 limit, so that will be $4,960. So total payroll tax expense for the employer will be $11,080. So employer will pay half of the Social Security and Medicare, and complete unemployment taxes up to first $7,000 of income of these employees. And in this case, will become $11,080. So we call this payroll tax expense. And a salary expense is $80,000. So salary expense $80,000, payroll tax expense $11,080. Okay. Okay. So hopefully you got the idea. Look at your book to see the journal entries also for payroll tax, and you can do the rest of the homework. But the things that I want to share here in regards to payroll, it was a little bit confusing. That's why I want to focus on that so you can understand exactly what's going on the payroll tax. If you couldn't get all of it, please watch this recording one more time, the area that I just covered, so you can have it at least 2 or 3 times if necessary, so you can understand this. Okay. Let me know if you have any questions, and you can show up in my office hours if you like. Bye-bye.